Good evening to all of you. You can also wish me. Good evening. So extremely happy to be here at another MMA event, and thank you, Captain Vijay Kumar, for the invite. And at the outset, I'd like to recognize, as Captain Vijay Kumar did, the presence of Mr. Mahalingam, immediate past president of MMA for the last 2 years. In fact, seeing him today, a little inspiring for me, because after 2 years of sweating it out for MMA and building a greater institution, it was a great institution, he built it a greater institution, somebody to come few days after demitting the office. Typically, public office, once you demit, feel, okay, I've demitted, let me settle down and leave it. But for him to continue with the same enthusiasm and come today and be here, sir, very inspired, very inspired. Of course, Captain, but very inspired. Thank you. It's a big message to the younger generation. So as far as the topic is concerned, at least those of you who know me or those from the accounting fraternity, I don't think anybody is expecting me to speak on taxation of capital gains. I don't think anybody has that expectation, and rightly so. But nevertheless, I still choose to accept this invite for 2 reasons. Reason number one, it was a friendship call from TGS, and some relationships you can never say no. The second is the topic. While the amendments had come up in the last budget, applicable for financial year 24-25, for which the tax returns are to be filed now. Tax returns are to be filed now. My interaction with cross-section of people, many of them have not taken note of the amendment itself or the finer aspects of the amendment. Many have missed it out. What has happened over time is, typically when budgets were presented in the parliament by the finance minister, it used to be reasonably elaborate, and immediately after the budget we used to have significant amount of workshops, etc., to interact and understand. But what's happened over time is the finance bill presentation times have been shrunk. So they have shrunk it to such an extent that they just read out the headlines and all the details are completely missed out. And in our busy lives with 2-3 headlines of this country bombing that country and all, you tend to miss out to catch the details of the amendments. So on this topic of capital gains alone, and as Captain Vijay Kumar mentioned, I wish all of you personally have some capital gains tax to pay, which is a welcome sign. And I'm sure after listening to Mr. TGS, you'll have opportunity to do both compliance and planning as well. There are about 12 amendments I could figure out which are applicable. And these are amendments which not about rewiring, it's about wiring itself. So while the topic of the session is about rewiring, it's about wiring itself, because these are all fairly material amendments. I'll not talk about those amendments because he's the right person to speak about it. But there's one amendment I'd like to speak about because of its impact, and I hope either in the next finance bill or years to follow, there will be a reversal of the position. So there is a particular tax amendment which has happened, which is applicable for 24-25 and will continue for financial year 25-26 also. But hopefully thereafter, I sincerely wish that position gets corrected. This is the capital gains relating to buyback of shares. As far as the buyback is concerned, there are good number of companies who generate lots of surplus, and they don't have capital deployments to do or deploy the profits which are earned. They tend to buy back the capital over a period of time, which helps them to maintain the capital base at the optimum level and also do some shareholding related corrections in terms of who holds how much. So it's a very important corporate tool which was available. And there are also instances where companies have a one-off substantial profit, sale of a division, sale of a factory, and you end up with a substantial profit, which is a surplus cash which you are sitting in the balance sheet, and you would like to do a capital reduction. So buyback is a very powerful tool available for companies to ensure the capital of the company is put to productive use and any excess capital is returned back to the shareholders. There are companies like TCS, Infosys, who have regularly gone through this program of capital buybacks and maintained the proper use of the capital within the company's concern. So what this amendment seeks to do is the following in a nutshell. But if what I'm explaining is erroneous, you'll have to accept the position that whatever TGS tells later is the final position. This is my little understanding. He is a hardcore tax person, and I have not had a situation of handling a live case of somebody doing a buyback. And after this amendment, companies have literally stopped buyback. They have actually stopped doing buyback, which is a very important tool. Now, what it says in very simple words is, you have a share face value of 10 rupees. I buy shares in the market at 150 rupees. And few years later, I sell it at 500 rupees. So what this law seeks to say is, since the company is using its profits to buy back, the entire 500 rupees should be treated as akin to dividend income and will be treated as income subject to tax. And the 150 rupees which you have paid for buying the share, you can treat it as a capital loss. If you have some other capital gain, you can adjust it. If you don't have a capital gain, you can carry it forward and set off in the future. That's in a nutshell about the provision. So he's nodded his head, so he can't change the explanation. Okay, that's in a nutshell about the provision. The fundamental assumption here is the buyback is always happening out of. The fundamental assumption or the understanding which the legislators have is the buyback is happening entirely out of the earned profits, companies' profits which are earned profits. But law allows buyback to be done also out of securities premium, which is a capital amount. So when people have subscribed to shares, you have contributed capital, and that's the capital which you actually get back, in a buyback. But the assumption here is, irrespective of what you use, the entire amount will be treated as a dividend income. That's one gap which is there, a conceptual gap in my view. Similarly, a second situation is, when I buy the shares at 150, the book value of the share, the accumulated profits of the share of that particular company, it's an existing company, accumulated profits, the book value of the share is also, let's say, 150. So which means I paid 150 for exactly the net assets which were there on that day. So the earnings which I've added after that, are only my revenue earnings. So at best, that difference between 150 and 350 can become a revenue in nature and not otherwise. And for this particular subject, at least there are some misuses which are happening, and every tax position, there will always be some amount of misuse. But conceptually, I felt it was a little unusual kind of an amendment. And there can be many situations where I just am a holder of shares. I don't sell. For example, my own personal thing, I've not sold. I just buy, keep it, whatever has been done, little, you'd buy, keep it. So if you end up with the buyback proceeds coming and the capital 150 if I have to write off, I don't know when I'm going to sell. So that entire amount of loss also I tend to lose. So this is a provision alone. I'm just trying to tell there are 12 such things. One provision, which is very material, is what I thought I'll speak about. Of course, TG might have a little edited view of this because he handles it on a day-to-day basis. But conceptually, I thought this is something which Kati correct da dai Kati correct na sonnadu nasu correct da na idhurku explain pannadhu correct dane seri okay. So as far as this provision is concerned, I sincerely wish within at least next year or thereafter there's a recognition of the fact that there's a need for conceptually editing this, and hope we get to the right taxation position. So with this, let me wish you great learning, and also in the leadership of Mr. Mahalingam and Captain Vijay Kumar, last year they constituted a CFO forum, and this program I understand is the first program under the aegis of the CFO forum. So I wish the forum also a great success like several of the other initiatives of MMA. So with this, let me invite TG to address all of you. Thank you for
நம்ம இப்போ இங்கே அதுதான் இருக்கும் நினைக்கிறேன். இப்போ குட் ஈவினிங். பரவாயில்ல, அப்போ டிஃபன் சாப்பிட்டுருந்தாங்கன்னு நினைக்கிறேன், அதனால கொஞ்சம். So this is actually the true friendship. You know, like in true friendship, it need not necessarily have to, you know, like do similar things. Now, exactly the buyback slide is the one which I deleted before coming to this program. Because I thought we may not have that much amount of time. And of course, there are a lot more serious issues. Not that this is not serious issue, but I'm saying, so, anyhow, he has already given you a hint, but I also given a hint that I'm not going to talk on this. So anyhow, before I proceed, I think it will be unfair if I don't really dedicate this to, without them I'm not here. So, and also once again, thank the Guru Captain Vijay Kumar and the past president. So MMA is one organization who is, you can be rest assured. In fact, 2-3 days before, I was in the parking lot. I was there. I mistook the time as 3:45, and therefore somebody was saying that everywhere, one thing you can find out, if somebody is there in the parking, howsoever beautifully you park, they will once again ask you to go back, and then park. I thought the time was there. I missed out, but being an MMA, you can be rest assured. Even if I'm not there, the program will go on. And that's what we have been working on a particular school for 3-4 years. That's what I've told, even if both of us not there. Therefore, going forward, don't think this is an ICR without any listening to them. ICR, any other place where the program is on, where 6 means 6:30. Here 6 means 6. Even if the speaker is not there, program will go on. So, therefore, next time, whenever you are attending a program here, you can be 200% be assured that there is no scope for any 1 second delay also here. With this, why I'm saying that, because we have a limited time, we have to ensure that, you know, we cover as much as we can. So this was a beautiful starting. The trailer, actually, I really like this trailer. And the trailer, actually, she said, I'm going to simplify. And I'm going to introduce a new tax. The beginning has been made in the finance bill by simplifying the tax regime and capital gains taxation. Now, the real fallout of this, Infosys is not able to fix the simplification. And that is why already due date has been extended to September 15th, and you can be rest assured. Right now we are not going to see the light of it. And in fact, whenever I see this line, I'm always reminded of one beautiful chapter in Operation Research or Quantitative Techniques, which is called as a simplex table. Because I found the costing president is here, past president of Cost Accounting Institute is there. It will be unfair if I don't. So, in fact, he was the first person to register for this program. That is his commitment. Now, this one chapter name is called Simplex Table. If you have done this chapter, I always used to wonder who kept the name for this chapter, Simplex Table. If you have done the Simplex Table, go and do. It doesn't deserve that name. But thereafter, I understood. I think we need to go and change Wikipedia. So whenever the word simple or simplex is used, you can be rest assured. That means it's going to be very, very complex. Day before yesterday also I was in Hyderabad, and I was pretty surprising to find that many of my CA friends were pretty shocked after that 1 hour. Are you sensationalizing? Is it the real law? I said, there's no need for me to sensationalize, but this is the real law. Unintentionally or intentionally, we don't know, but this is the state of law. So what I will try to do is, given the time I have, I will just try to show as many examples as possible so that you understand the implications of the same. I skipped the agenda because I'm not sure whether we'll have the time to take all the agendas which is there. Now, the most important point, there is no choice available for indexation if you are going to transfer the asset after 23rd July 2024. Be clear. There is no choice available for computing your capital gains. In your income, total income statement, your capital gains will always be without indexation on or after 23rd July 2024. There is no change has been made in section 48 of the Income Tax Act. Capital gains computation is always going to be without indexation only. So that you have to be very clear. I'll talk about the implications later on. So tax rate reduced from 20 to 12.5%. Of course, all of you know about this particular point. And as there was quite a lot of hue and cry about this particular provision, including a lot of tweets from various personalities, before the bill was passed as an act, for individual and HUF in respect of land or building or both acquired before 23rd July 2024, the tax payable calculated, we can call the current capital gains system as a new capital gains tax regime. So if the tax payable calculated as per the current tax regime or the new regime, under the old tax regime you compare, if the tax payable is more when compared to the tax paid in the old regime, that excess tax you don't have to pay. The excess tax shall be ignored. That means you must understand the change is there only in the tax calculation part of it, but there is no change in the capital gains computation part of it. Looks like a very simple change, but as we are going to see some further slides, you will know the unintended consequences of this. The idea is good. The idea is that we should not complicate. We'll make it simple. Now, why they have done this? They have given in the memorandum the ease of computation of capital gains for the taxpayer, and of course, tax administration will also find it easier. Of course, most of us generally use only tax software. If you put the year of sale and year of acquisition, normally these things are not manually calculated now. So therefore, to that extent, since it's automated, I'm still not convinced about this point, but nevertheless, that's what they gave us a reason. So we'll just skip this given the time factor. Now, this is something which you need to spend for concern. Even if you are not savvy towards the tax language, at least for the next 2-3 minutes, you just read this. I will also read along with you. This is how change has been made, not as many of us commonly understand. They have not changed 48. Now, if you know the sequence of the section, indexation is provided by the second proviso to section 48. That has not been changed at all. Computation of capital gains is there in 45 to 55. Now, where they made a change, the change has been made in section 112 1A. So 112 deals with tax payable in the case of long-term capital gains. This comes under Chapter 12 of the Income Tax Act. So where is a change they made? Provided further in the case of a transfer of a long-term capital asset, being land or building or both, which is acquired before 23rd July 2024, where the income tax computed, I've just tried to show in bold, where the income tax computed under item B exceeds the income computed in accordance with the provisions of this Act as they stood immediately before this amendment by the Finance Act number 2024, such excess shall be ignored. So the simplification, so I will try to put in a simple language. What they are trying to say is that calculate 12.5% without indexation. It's always should be your calculation. But while calculating your final taxability, calculate 20% after indexation. If the 20% after indexation is lesser, then you don't have to pay that excess tax. So that means your tax calculation, computation, all are going to be without indexation only. Finally, when you come to your tax payable calculation, you have to calculate 20% after indexation, which is a provision which existed before this change. If that tax is excess, we will ignore the tax. So therefore, don't think that you've been given an option to choose between with indexation, without indexation, or no choice at all. Choice is there at the time of calculation of tax. Now, I can understand that this could be too technical, and in fact, so therefore I just want to make it a little bit more simpler. I'll just try to give you some lot of simple examples for you to appreciate why Infosys is struggling to fix this problem. I think we have to be fair to them also, because it's very easy for us to come back and say, MPV is also from IT industry, so he knows these challenges. Especially when the law is not complicated like this. Now, the benefit, whatever you are talking about, is there only for resident, individual and HUF. If you are dealing with your non-resident friends, clients, etc., no indexation, nothing. Straight, simple calculation only. If you are dealing with firms, LLPs, companies, this benefit is not available. It's available only for individual, Hindu undivided family who are resident in India. And the changes are there only in the tax calculation. Therefore, indexation benefit is not available even after this amendment. So therefore, to that extent, while calculating your capital gains, this must be the 5th or 6th time I'm saying, I was shocked across many CA forums where many people thought the indexation is available. In fact, a lot of people are even asking the question why they should extend without even be asking for it. This is going to be purely a software adjustment related problem. Now, how this is going to impact your carry forward of losses and exemptions, I will tell you, every time I put an example on this, I'm getting some extraordinary results. These are all some mathematical beauty. I started my teaching career as a maths teacher. I'm enjoying the mathematical beauty every time I put an example. So we will just try to see some examples here. Now let's take a very simple example. The full value of consideration, 100 lakhs. Cost of acquisition, that 2000 is the year of acquisition, which is 8 lakhs. The fair market value or guideline value as on 1/4/2001, 10 lakhs. We all know that cost inflation index, 363. 2001 to our base year index, 100. Just for the sake of simplicity, I've taken it as how this transaction gets affected if you have sold before 1st July 2024, which is obviously before 23rd July 2024, and if it is 1st August 2024. So you must understand, in this year, up to 22nd July 2024, if the asset is sold, you have a different calculation. If it is sold on and after 23rd July 2024, you have a different calculation. For certain mutual funds, if it is sold before 23rd July 2024, 36 months will make it long term. If it is sold after 23rd July 2024, 24 months will become long term. And if that mutual fund happens to be a specified mutual fund falling within 50 AA, even if it is long term, tax payable will be calculated as if it is a short term. இது உங்களுக்கே எப்படி தலை சுத்தம்னா சாஃப்ட்வேர் பீப்புளுக்கு எப்படி தலை சுத்தம் பாருங்க. இது நான் சொல்றது 1,000th of it. I am not touching what MP said. It's a story by itself. 30th September and 1st October. Right. Now let's take a very simple example. Now just see the top of it, which is very, very important. Impact of this amendment in computation of capital gains for all assessees. All assessees. Don't distinguish between individual HUF company. Any one. This is how you have to calculate the capital gains. Why 1st July 2024, which is before 23rd July 2024. You can take it as up to 22nd July 2024. That will be the calculation. If it is after 23rd July 2024, 100, again if you go to the previous one, consideration is 100, consideration 100. Till 22nd July 2024, you are eligible for indexation. Therefore, this will be calculated in the base of 363 by 100 into 10, so 20, so 72.6. So 20 is the 1st August 2024 calculation. So capital gains will be 80. So calculation of capital gains, same for individual HUF companies, everybody, no change at all. In your total income calculation, this will be the number, except for the fact that FME that should be taken as 20 lakhs as wrongly typed as 10, so take that as 20. Right. Now, what is this impact of this amendment in computing the tax payable for persons other than individual HUF or resident? Now, first one, we are only talking about calculation. How this changes will impact the tax payable. This again, see the heading of the slide, for persons other than resident individual and HUF. If you are not a resident individual HUF, tax will be 20% of your long-term capital gains up to 22nd July 2024. Tax on or after 23rd July 2024, 12.5% of 80. So for these people, you don't have to worry about, no need to check two methods of tax calculation law. Very simple. Take 20% of indexed cost of acquisition, subtracted capital gains. If it is after 23rd July 2024, it's going to be 12.5% of 80. Up to this also acceptable because there is no choice for them. Next 10-15 minutes is where we'll have the best of the amendment. Now, Wine Infosys is still fixing it. Now, this impact of this amendment computing the tax payable for resident individual. Why this is very important? All of us are going to handle only this set of people substantial. So, if it is 1st July 2024, 100, 72.6, 27.4, 20% of 27.4, 5.48, no problems at all. Now, what is most important, because I'm just cutting this second column primarily because that you have been doing for quite some time. There is no issue at all. That has not changed. What has changed is if the sale is on or after 23rd July 2024, how do you make the change? 120, 80, no change at all. In your total income statement, gains will go only as 80. Don't even have second thought. Your income statement should show your long-term capital gains only as 80. The tax payable at the rate of 12.5% comes to 10. What the government is now saying, if the change had not taken place, because I've taken the same numbers, therefore it's more easier. If the change had not taken place, what is the tax payable? Is there in the second column. What is the tax payable? 5.48. After the change, what is the tax payable? 10. So since the tax payable after this amendment is 10, as against the tax payable before this amendment, which is 5.48. So what the government comes back and says, we will ignore the excess. That means we will take the tax payable only as 5.48. No, because no, you have to wait and see. You are in such a hurry. So I know about you, so therefore you wait for some more time. In this particular case, it works, right? So, now we'll take the same case. The only change I have made, instead of 100, I've taken the amount as 200. So instead of 1 crore, I've taken the sale value as 2 crores. I will skip the second column for the simple reason. That has not changed. We'll assume that you know that. Whether you know it or not a problem. We'll assume that you know that. Now, 200 minus 20 my long-term capital gains is 180. Please understand, in your total income statement, the capital gains will go only as 1.8 crores, not 127.4. And I don't have to tell you, once your income slab changes, your surcharge, tax payable, everything is going to change. That's what you have to understand. Now, the tax payable at 10% of 180 comes to 18. The tax payable before indexation or before the provision was changed came to 25.48. Now what they say that you pay 18 because this new capital gains tax regime is easier for you or lesser for you. Therefore, you can pay tax at 18. So whereas in the previous case, you were asking why they should change. Now here, the change will benefit you. I will just give you a rough number. For 2001-2, if your sale value is more than 8.01 times, it will be better off. If you're, well, for the sake of simplicity, take it as 8 times. So that means if you're purchased by 20, at 160 lakhs, up to 160 lakhs, the old will be better. If you're able to achieve more than 160 lakhs, new will be better. That's one small cutoff. There's a slide is there for you. But more than that, the very interesting part of it now. Now, how do you calculate after this? These are some very, very important issues with which you address. How to calculate the exemption under 54EC now? Or 54F, 54. How do you calculate? Will the losses be allowed to be carried forward? If there is no indexation is going to be there, today it's impossible for you to get a loss. Very difficult. You buy in 2001 for 10 lakhs. I don't think you're going to sell in 2024-25 for 8 lakhs. If at all a loss comes, it's always going to be after indexation. Now, what will be the position in the case of non-residents? Now, what will be the position in the case of properties which are inherited on or after 23rd July 2024? There are some more issues we'll also take, which will make the next 15-20 minutes the most exciting one. And definitely after the next 10-15 minutes is where you will understand why the government is extended, and it looks like it may be further extended, but at least another 15 days as of now. Right. So same thing, full value of consideration 100, cost of acquisition 20, long-term capital gains 80, capital gains after indexation 100, 72.6, long-term capital gains 27.4. Now, how much you should invest for the purpose of 54EC? Now your time. We talked about, we'll just make it a little bit open. How much you should invest in this particular case for the purposes of 54EC? So you have to invest in REC bonds, right? Indexation benefit is not available if you have sold on or after 23rd July 2024. This you take it as sold on or after 23rd July 2024 only. So 100 is my consideration, cost of acquisition 20, long-term capital gains 80. You will not get the benefit of indexation for the purpose of computation of capital gains. I want to invest in 54EC bonds. How much I should invest now? 80, but you are not allowed to invest 80 because 54EC restricts the investment to 50. So that means, should I have to pay tax on 30? That's a very interesting point. Now, I will tell you, please understand, this is one reason why even the software is struggling to adjust to this particular point. Now, in my view, you should invest only 27.4. Now, why you should invest only 27.4? Now, let us assume you have invested 27.4. What if your taxable long-term capital gains? 80 minus 27.4, right? Just for the sake of easy calculation, we'll take the investment as 30. So if I invested 30 in 54EC, how much is your capital gains taxable? I taken 30, easy number.